Good morning, everybody. Today is Thursday, June 20th, 2013. Welcome to my video update. Three things I'll talk about are the economy, the markets, and the accounts. Right now, the economy is tough to say. It's whether we're growing or not. ISM numbers, Philly Fed, were not very good. Jobless claims are coming down, or I'm sorry, I should say unemployment rate is coming down, and so that is the one positive. However, yesterday, the Federal Reserve, Ben Bernanke, came out and said that they might be tapering off on the Federal Reserve's bond buying process, which has been going on since 2009. Whether or not that, obviously the market did not like what they heard, and since then the market's down about 2%, and that was from 2 o'clock yesterday. We're going to have to see what happens. I mean, there really is a lot of issues going on right now, but one thing to be certain, and I know I've said this many times, is it just shows how much our global markets are dependent on this Federal Reserve and European easy monetary policy. Okay, normally when you see stocks in a lot of trouble, well, a good place to be is the bond market. Okay, the two used to work inversely with each other. We're not seeing that anymore. And what we're seeing yesterday is, and really in the last couple of weeks, are as stocks have gone down, mostly international stocks. I mean, a lot of people don't know this, but international stocks are down about 10, or averaging about 10% this year. China being down much more, Brazil being down much more, Canada's down. All of the international markets are down, the US is up. Okay, but when we look at this right now, the important thing to see is the bond market is also getting hit just as hard as all the other international stock markets. Emerging market debt's down about 14%. U.S. corporate bonds, something that we've made a good money in the last 4 years, is down on the year. You know, people always ask me about PIMCO total return. Dan, is that a good place to put my money? That fund's down 9% and is negative for the year. So you know, really right now and which brings me to my third point is, why are we holding so much cash? And the point is, well, when the bond market is going down and the stock market is going down and the commodity market's going down, it really leaves us with very few options where to put money. And I think capital preservation is a very good thing for us to look at over the next several weeks until we can watch the market settle and try to find opportunities. Everything that we've been looking at with dividend producing assets, these things are very interest rate sensitive and have gotten hurt. A lot of times people say, well, it's good to be in a stock for a 3% or 4% dividend. Well, we were in a 4% utility fund. We got out with a really nice profit. Since then, it's given back over 12% of those gains. The same thing with real estate. They all produce nice dividends, but that is not worth losing 10% of your principal. Okay, so we've exited these positions. That's why we're holding cash. I don't want to be in cash, but right now it's the safest place to be. We still do own a couple of mutual funds. One of them is a Standard Life company, which is a global, it's an absolute return. So it's looking for an absolute return, not yield, and it looks all over the world for that. It has an excellent track record. The other one is our John Hancock Strategic Opportunity Bond Fund. This hedges bond portfolios, and what it does is it hedges it with currency risk, and it go long or short on the treasury yield. These things are really helping us, like especially if you saw the performance of these funds yesterday when the market got crushed. I mean, these were barely down, and these are two holdings I'm going to hold on to because I'm very confident in, and because they are positioned for the uncertainty ahead. With that, thank you very much for tuning in. If you have any questions, please give me a call. The last thing I want to say is, thank you so much to those who sent me cards and emails and phone calls, with the passing of my father-in-law. So thank you very much.